Hey everyone, welcome back to Corporate Dakota, the place where we unpack the financial mysteries of the corporate world with a smirk. Today we're diving deep into Northern Technologies International Corporation's latest quarterly report for November 2025. Get ready for some interesting insights into how this company is performing. Alright, so Northern Technologies International Corporation, or NTT as we'll call them, just dropped their quarterly report and we're going to break down what it means. They're reporting on the period ending the 30th of November 2025. This is essentially a check-in on their financial health and operational performance. Let's start by looking at their balance sheet. Think of this as a snapshot of what the company owns and owes at a specific moment. On the 30th of November 2025, NTA had about $104 million in total assets. That is up slightly from about $102.7 million back on the 31st of August 2025. Now, among their current assets, which are things they can turn into cash relatively quickly, their trade receivables were over $18 million. This means customers owe them a good chunk of money. They've set aside about $290,000 for potential bad debts there, and their inventory was also quite high at over $16 million. This is the stuff they plan to sell. On the flip side, their short-term liabilities, or what they owe in the near future, included a line of credit balance of over $9 million. This is essentially money they've borrowed and need to pay back soon. Their total current liabilities were around $25 million. What really matters to investors is the stockholders' equity, which is what is left over for the owners after all. Debts are paid. This stood at over $76 million, which is a good number. Despite some slight fluctuations, it shows the company has a solid base for its shareholders. Now let's talk about how they did in terms of making money. Their statement of operations, this shows their revenues and expenses over a period. For the 3 months ending the 30th of November 2025, NT brought in about $23.3 million in net sales. That is an increase from about $21.3 million in the same period last year. So sales are up. However, the cost to make these products, their cost of goods sold, also went up significantly to about $14.9 million from about $13.1 million. This means their profit margin on each sale, their gross profit, stayed pretty flat at around $8.3 million. What is interesting is their income from joint ventures. They got over $1.2 million from these partnerships this quarter, which is up from about $1.1 million last year. This suggests their joint ventures are doing reasonably well and contributing to the bottom line. When you put all the operating expenses like selling, general, and administrative costs together, their operating income actually decreased a bit. It was about $933,000 compared to over $1 million last year. And at the end of the day, the profit that belongs to NTIC shareholders was about $237,000. This is down from about $561,000 last year. So while sales are up, other costs ate into their profits. This translates to about $0.03 per S-hair this quarter, down from $0.06 per Hess hair last year. Beyond their main profit and loss, they also have something called comprehensive income, which includes things like foreign currency translation adjustments. For this quarter, they had a negative comprehensive loss of about $34,000 attributable to NTIC. This is an improvement from a larger loss of over $700,000 in the prior year. Looking deeper into their assets, their intangible assets, things like patents and customer relationships, were valued at over $8.5 million. This shows they have valuable intellectual property. Then there is their joint ventures. Their share of earnings from these partnerships is significant, totaling over $28 million in undistributed earnings. They have joint ventures in places like Germany with Xcore, and others in places like Finland, represented by Zerust Oy. Now let's talk about their debt. They have a credit facility with JP Morgan Chase Bank for up to $10 million. As of the end of November 2025, they had borrowed over $9.1 million on this line of credit. They also have term loans in China and India for their subsidiaries there. It is worth noting they had some shares issued under their employee stock purchase plan, about 5,198 shares in this period. This shows they are engaging their employees but also subtly diluting ownership for current shareholders. The company breaks down its business into two main segments, Zerust, which deals with rust prevention, and Naturotech, their bio-based plastics. Zerust sales were strong, increasing by almost 12% to over $17 million. This segment really seems to be driving their top-line growth. Naturotech sales, however, only saw a small increase of about 2.2% to nearly $6 million. While the market for eco-friendly plastics is growing, this segment appears to be facing some challenges or perhaps just slower growth compared to Zerust. Their selling expenses went up a little by about 2.4%, but as a percentage of their total sales, these expenses actually went down, which is a good sign for efficiency. General and administrative expenses increased by about 7.5%. This is mainly due to higher costs for professional services and travel. As a percentage of sales though, these costs also slightly decreased thanks to higher sales. Research and development expenses saw a drop of over 9%. This could be a sign they are shifting resources towards sales and marketing, or perhaps it means less investment in future product innovation. Overall, NTIC's consolidated net sales increased by 9.2%. That sounds great, but remember how we talked about costs going up. This is where we see that impact. Income before taxes came in lower for this quarter, about $770,000 compared to over $1 million last year. And ultimately, the net income attributable to NT shareholders was down by more than half, from $561,000 to $237,000. This is a pretty significant drop in profitability. The company is exposed to foreign currency exchange rate risks, meaning fluctuations in currencies like the euro or the Chinese yuan can affect their earnings. They don't hedge against this, meaning they are fully exposed to these currency movements. They're also dealing with tariffs which are adding to their costs, especially for their Nacha tech business. They are trying to manage this through diversification and other strategies. This mention of risks related to China is important. Geopolitical tensions and potential tariffs between the US and China pose a significant risk to NTIC's operations there. The company explicitly states that their earnings are subject to quarterly fluctuations. This is largely due to the unpredictable nature of sales in the oil and gas sector for their Xeris products, and also their Naturtech business. This means investors might see some wild swings in performance from one quarter to the next. Here is a really interesting risk. They're starting to acknowledge the impact of artificial intelligence. They recognize that if they don't adapt to AI, or if competitors use it better, it could hurt their business. This shows they are aware of technological shifts, but the question is, how quickly can they integrate AI? Overall, Northern Technologies International Corporation is showing sales growth driven heavily by their Xeris division. Their joint ventures seem to be holding their own. However, their profitability has taken a hit this quarter due to rising costs, particularly in their cost of goods sold, and increased operational expenses. They also face significant risks from international trade, currency fluctuations, and a growing awareness of the need to adapt to AI. While they have a solid base of equity, the decline in net income is something to watch closely. The company's strategy appears to be centered on expanding Xeris, especially in the oil and gas sector, and growing their Naturtech business. But they need to manage their rising costs to translate sales growth into shareholder value. Alright, that is our breakdown of NTIC's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think they can turn that sales growth into better profits? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives into corporate finances month after month. Don't forget to check out the Discord community linked in the description below for more discussions and insights. Thanks for watching. See you next time.